that will convey a right of use asset in exchange of a liability, in exchange of a consideration, And in a lease, we say that the lessee will be considering to have what we call right of use. Then we have the lease liability. Right of use and the lease liability. Those are the things that the lessee will be recognizing in the lease. And we said that on initial recognition, you are going to recognize the lease by debiting the lease and crediting debiting the right of use and crediting the lease liability. That is on initial recognition, But on subsequent measurement, the right of use will be depreciated on straight line basis, and the lease liability will be amortized. Right of use, you depreciate on straight line, but the lease liability, you amortize. How do you amortize? We said when you want to amortize, it will depend if payments are made in arrears or payments are made in advance. And I believe we did questions on both, so that you see if I'm paying payment in arrears, how do I make the amortization schedule to recognize the expense, that is the finance cost, and also to recognize the liability at the end. Then if payments are made in advance, how do you recognize the expense? How do you recognize the liability? And remember, in a lease, when you are recognizing the liability, we said, you are going to separate between current and non-current liability. That is according to IFRS 16. You separate. Therefore, today we want to look at sale and leaseback. Sale and leaseback. Sale and leaseback. Today we want to consider a segment of sale and leaseback. Now, when we talk of sale and leaseback, this is where the asset is originally yours. The asset is originally what? Yours. Therefore, you decide that because maybe you don't have enough money to invest in your business, but at the same time, you need the asset. Let me assume, for example, it is a motor vehicle. It's a motor vehicle. Therefore, you remember you need money to operate in the business. And at the same time, you also need a motor vehicle to facilitate the business. Therefore, what do? You sell the motor vehicle, then you get the cash, then again, you lease that motor vehicle for your use again. Therefore, that is where the transaction we call sale and leaseback transaction. That is a transaction we are referring to, a sale and leaseback transaction. Therefore, according to IFRS 16, we are required to recognize this sale and leaseback. How do you recognize this sale and leaseback in your financial statement? Therefore, my good friend Paul said that we are going to go very slowly so that everybody understands the concept on what we are talking about. Therefore, let's introduce and say a sale and leaseback transaction. Let's introduce and say a sale and leaseback transaction occurs. A sale and leaseback transaction, occurs when one entity, in bracket, the seller. When one entity, in bracket, the seller, transfers an asset to another entity, transfers the asset to another entity, in bracket, buyer, to another entity, in bracket, buyer, in bracket, buyer, in bracket, buyer, in bracket, buyer, who then leases the asset back, who then leases the asset back, who then leases the asset back to the original seller, who then leases the asset back to the original seller. Let me repeat the whole statement so that maybe you did not understand something, you correct. I said, a sell and leaseback transaction, a sell and leaseback transaction occurs when one entity, in bracket the seller, transfers an asset to another entity, transfers an asset to another entity, sorry. I was saying a sell and leaseback transaction occurs when one entity, in bracket a seller, transfers an asset to another entity, in bracket buyer, who then leases the asset back to the original seller, who then leases the asset back to the original seller, to the original seller, who then leases the asset back to the original seller. Then you put a dash and say, 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 the companies are required to account for the transfer contract. The companies are required to account for the companies are required to account for the transfer contract. The companies are required to account for the transfer contract and the lease, transfer contract and the lease, transfer contract and the lease, applying IFRS 16. The companies are required to account for the transfer contract and the lease, applying IFRS 16, applying IFRS 16, applying IFRS 16, applying IFRS 16. However, consideration must first be given. However, consideration must first be given. However, consideration must first be given to whether, however, the consideration must first be given to whether the initial sale, to whether the initial sale of the asset, the initial sale of the asset, however, consideration must first be given to whether the initial sale of the asset is a performance obligation, is a performance obligation, a performance obligation, a performance obligation, a performance obligation under IFRS 16, under IFRS 15, under IFRS 15, under IFRS 15. Consideration must first be given if the transfer or the sale of the asset is a performance obligation under IFRS what? 16. Now listen, I explained this point before we go to another segment. Now, what we are saying here, you are selling the asset, you are selling the asset to another person, then you lease it back. Therefore, for you to start recognizing as a sale, it must be a performance obligation under IFRS what? 16. I believe from your section intermediate, you discussed IFRS 15, revenue from contracts with customers, revenue from customers, revenue from contracts with customers. How do you recognize revenue from contracts? That is under IFRS 15, how to recognize revenue. Therefore, what we are saying, for us to say it was a sale of an asset, it must qualify the provisions of IFRS 15, a performance obligation under IFRS 16, revenue from contracts with customers. That is what we are saying in that statement. Because I cannot just recognize revenue if the performance obligation does not qualify to the provisions of IFRS what? 15. Therefore, it means that you are also required to understand the IFRS 15. ED Osundwa, I said, the performance obligation under IFRS 15. Under IFRS 15, Kuminatano, IFRS 15, revenue from contracts with customers. Therefore, for us to recognize it, it must qualify that. That is just a point to note. Now, let's look at how to recognize sell and leaseback. Let's see how to recognize sell and leaseback. Let's see how to recognize sell and leaseback. We say how to recognize sell and leaseback. How to recognize sell and leaseback. How to recognize sell and leaseback. How do I recognize that? Number one, listen very carefully because this one we are going to use it for questions. Number one, recognize sell proceeds, recognize sell proceeds, recognize sell proceeds. Remember, the asset was yours and you are selling the asset. Therefore, what you are saying, number one, you are going to recognize sell proceeds. How do I recognize sell proceeds? Because I'm selling an asset, you are going to debit what? Bank. You debit bank, you are receiving money. Therefore, you debit bank. Number two, they recognize the asset. They recognize the asset. They recognize the asset. You de-recognize the asset. To de-recognize the asset means you are going to remove the asset from your books. You credit asset, credit asset. You credit what? Asset, because you are going to remove it from your balance sheet. Number three, recognize the lease liability. Recognize the lease liability. You recognize because after you have sold the asset, you are now leasing it back. When you lease back the asset, you recognize what we call the lease liability. Here you are going to credit lease liability. LL means lease liability. Then number four, recognize the right of use. The right of use. The right of use, you are going to debit ROU. You debit ROU. You debit the right of what? Use. You debit the right of use. After you recognize the proceeds, you sell the asset. You recognize the asset, you remove it from your financial statement. Then you come to recognize the lease liability. At the same time, you recognize the right of use asset. Therefore, these two, the first two, this is the sale of the asset. The first two deals with the sale of the asset. Then the last two here deals with the leasing of the asset. This one, we are leasing the asset, but the first one is selling of the asset. The first two is the sale of the asset. The second is the lease of the asset. We are going to lease the asset back. Then number five, recognize. Number four, you say, recognize a gain or a loss. Recognize a gain or a loss. In bracket, you say balancing figure. Balancing figure. Recognize the gain or loss. In bracket, you say as a balancing figure. On the right, transferred to the buyer. On the right, transferred to the buyer. On the right, transferred to to the buyer. Recognize a gain or loss as a balancing figure. Where are we getting the balancing figure? From these 4 transactions, the balancing figure on the rights transferred to the buyer. Let me explain that statement as we move on. The first statement is IFRS 16 and the last is IFRS 15. Yes, it's correct. It's correct, IFRS 16 and IFRS 15. Because we are recognizing the lease under IFRS 16, but when we go to recognize the sale proceeds, we are recognizing as per performance obligation under IFRS 15, revenue from contracts with customers. I'm just commenting on Esther Mutinda, right of use. ROU stands for right of use. Thank you very much. And remember, in an exam, you don't say ROU. You don't say ROU. You say the right of what? Use. Because in the standard, there's no abbreviation of ROU. Therefore, if you say ROU, then many of us will wonder what is ROU. You say the right of use. The right of use. Now, what we are saying here, let me explain something. Under IAS 17, remember, Leases was taken from IAS 17. Under IAS 17, when you sold the asset, let me explain something. When you sold the asset, for example, the asset carrying amount is 200. You are selling it at a fair value. You are selling it at fair value 300. The asset carrying amount, book value is 200. You sell it at fair value 300. Then you are reporting that I have a gain. You are reporting a gain of 100. Listen carefully there. You are reporting a gain of 300. I'm explaining something why I'm saying here recognize a gain or a loss, a balancing figure on the rights transferred to the buyer. I'm explaining here. Remember previously, in IAS 17, your asset book value was 200. Then you sell it, because here we said you are going to sell the asset, you recognize the sale proceeds, fair value, let me say 300. Then you recognize the asset carrying amount, let me say 200. Therefore, you are recognizing a gain of what? Of 100. There, we were reporting that profit of 100. But today, under IFRS 16, you don't recognize this gain. You don't recognize this gain, but the standard is dividing it into 2 rights. The standard, when you are transferring the asset, then you lease it back, the standard is dividing it into 2 rights. We have the rights that you retained as the seller and the rights you transferred to the buyer. We have 2 rights. The rights you retained yourself as the buyer, as the seller, then the rights you transferred to the buyer. Therefore, according to IFRS 16, you are only required to determine the gain on the rights transferred to the buyer, but not the rights you retained to yourself. I have just said, when you sell the asset, there are 2 rights. The rights you are retaining, why are you retaining the rights? Because you are taking the asset back. Therefore, there are rights you retained, there are rights you transferred to the buyer. Therefore, you are only going to determine the gain on the rights transferred to the buyer. That's why, according to IFRS 16, we are not going to recognize total gain that you received from the sale of the asset, but you are going to recognize gain or loss as a balancing figure on the rights transferred to the buyer. I believe when we go there, you will have that concept. You will have that concept. Therefore, this is how you are going to recognize sale and leaseback. Sale and leaseback. Now, how do you determine the lease liability? How do you determine the lease liability? You say lease, you put a dash and say lease liability. Lease liability. Lease liability, you say, under lease liability, this is the present value of minimum lease payment, minimum lease payment. It will not change here. The lease liability, remember, the same way we were determining the lease liability here, we are still saying what will be the lease liability under sale and leaseback? The present value of minimum lease payment discounted at the implicit rate in the lease. Present value of minimum lease payments discounted at the implicit rate in the lease. Discounted at the implicit rate in the lease. Implicit rate in the lease. Now, put another dash and say under sale and leaseback. Put a dash and say under sale and leaseback. Recognize under sale and leaseback. Under sale and leaseback. You put a dash and say, Kevin Wanjala, will it be correct to say the seller retains right of use and transfers to the buyer the right of ownership? Although the standard does not say that, therefore we cannot put our own words, but you just know that because you are transferring the asset, then you take it back. Therefore, there are some rights you retain, there are some rights you transferred, but the standard does not say the right of use, you are retaining the right of use, you are transferring the right of ownership. But if you take it and understand it that way, then that is awesome. That is awesome because you make it easy for you to understand. You make it easy for you to understand. That is a thumbs up. Mwalimu is giving you a thumbs up there because you must make ways of understanding the concept. That is one of them. A thumbs up there. Thank you very much, my good friend Wanjala there. Okay, you put a dash and say under sale and leaseback, recognize the right of use asset. Recognize. Under sale and leaseback, recognize the right of use asset, the right of use asset, the right of use asset as a proportion of the previous carrying amount of the previous underlying asset, previous underlying asset, previous underlying what? Asset, or previous carrying amount, underlying asset, or previous carrying amount. I'm saying recognize the right of use asset as a proportion of the previous underlying asset or previous carrying amount, or the previous carrying amount. Therefore, here we are saying we are going to recognize the right of use as a proportion of the previous underlying asset or the previous carrying amount, Therefore, let's see how we are going to recognize the right of use. ROU is the right of use equals to, how do I get it? We shall be taking the lease liability, that is the formula, divided by the fair value of the asset times the carrying amount. Therefore, we are going to get the right of use as a proportion of the previous carrying amount, Therefore, how under sale and leaseback, how do you recognize the right of use? How do you recognize the right of use? You take the lease liability over the fair value. Fair value is the amount you are selling the asset. Then the lease liability, we have computed the present value of minimum lease payment. Then the carrying amount is the original carrying amount that we have recognized here. Therefore, we are going to take ROU, the lease liability, over the fair value times the carrying amount, Therefore, under sale and leaseback, that is how you get what? The right of use asset, put a note and says, put a note and say, if the sale proceeds, you put a dash and say, if the sale proceeds are less than fair value of the asset, if the sale proceeds are less than the fair value of the asset, or if the sale proceeds are less than the fair value of the asset, or lease payment are less than market rentals, or lease payment are less than market rentals, or lease payment are less than market rentals. What I'm saying here before I go to what I want to say, let me explain that. Stay with me carefully. I explain something. What I'm saying is that, for example, what I'm saying here in that statement, for example, the buyer is giving you cash of 15 million. Therefore, the sale proceed is less than the fair value. That is what we are saying here. The fair value is 20 million. The buyer, remember you are selling the asset to a buyer. The buyer is giving you cash of what? 15 million, not at fair value. The buyer is not giving you at fair value. That is what I'm indicating here. If the sale proceeds are less than the fair value of the asset, or the lease payment are less than market rentals. This payment is less than market rentals. You continue and say, market rentals, the following adjustments are made to measure the sale proceeds. The following adjustments are made to measure the sale proceeds to the fair value. The following adjustments are made to measure the sale proceeds to the fair value. The following adjustments are made to measure the sale proceeds to the fair value. Number one, any below terms should be accounted for as a prepayment. Any below terms should be accounted for as a prepayment. Any below terms should be accounted for as a prepayment. Any below terms should be accounted for as a prepayment. I believe I will explain again. Number two, any above market terms should be accounted for as a prepayment, as a additional financing, Any below market terms should be accounted for as a prepayment, and any above market terms should be accounted for as additional financing. Let me explain again so that we come to the same page. Now, I was explaining here. The fair value is 20. You gave me 15 instead of 20. Therefore, this is what we call below terms. Therefore, if it is below terms, which means I received less amount than the fair value, then in a lease, we say you have made a prepayment. Me, as the seller of the asset, I have made what? a prepayment to you when I lease the asset back. I have made a prepayment of the difference, which is 5 million. Any below terms means I received 15 million, but the fair value was 20. Therefore, I received less 5 million. Therefore, if I received less 5 million from the buyer, then when I will be paying that asset, I have already made what? A prepayment. I have already made a prepayment. I believe you are getting that concept. I have already made a prepayment because I left some 5 million on your side. I left some 5 million on your side. Therefore, we account for it as a prepayment. A prepayment because I received less than the market terms. But we are saying here, any above market terms should be accounted for as additional financing. Above market terms means the asset fair value is 20, but you gave me 25. The fair value is 20, the sale proceed is 25. Therefore, you paid more than the asset. You paid more than the asset. My good friend Fatuma, did I pay a prepayment as a buyer or seller? Fatuma, you say not understood. Good, that is good. Lenene, you say, did I pay a prepayment as a buyer or a seller? Anyone here from Mombasa or Lamu? Now, Isabel, not clear. Thank you very much. Not clear on the buyer and seller. Now, let me make it clear. Here we have the seller of the asset, and we have the buyer of the asset. Now, let's make it clear. We have the seller, original seller of the asset. I was owning the asset, then I sold the asset to the buyer. Remember, the fair value to the seller, the fair value was 20 million. The fair value was 20 million. Then when I transferred this asset to the buyer paid 15 million. Remember, the fair value of the asset is 20 on the seller side because the seller is the person. Now let's say Mwalimu is selling a laptop to you. Mwalimu is selling a laptop to you. Therefore, the fair value of a laptop is 20 million, but you are giving Mwalimu here 15 million instead of what? 20 million. You are giving me 15 million. But remember, Mwalimu is still leasing this asset, taking this asset from you as a buyer, from you now as a lease, to pay again the lease rentals, to pay again the lease what? Rentals. Therefore, remember, you gave Mwalimu less as a buyer. You gave Mwalimu less than what is the market terms. Therefore, if you gave Mwalimu less, then it means when Mwalimu will be making the lease payment, already Mwalimu has made a prepayment. Already Mwalimu has made a prepayment because for you as a buyer, you paid less money. You paid less money to Mwalimu here because Mwalimu sold the laptop to you, then he leased back. Therefore, Mwalimu is the seller, you are the buyer. But you as a buyer, you paid less than the fair value of the asset. Therefore, on this side, Mwalimu, because we'll be paying the lease payment, Mwalimu has already made a prepayment. Mwalimu has already made what? A prepayment. That is what I'm saying there. Then, again, we have what we call above terms. Above terms. Above terms means Mwalimu gave you a laptop. The fair value of a laptop is 20 million. But for you, you paid 25 million instead of 20. We are not talking about the carrying amount. We are talking about the fair value of the laptop. The fair value of the laptop is what? 20. But for you, you paid what? You paid 25 million. Therefore, what does it mean there? It means that you lend Mwalimu more money. You gave Mwalimu more money. Therefore, Mwalimu has a liability, more liability. That is why we are saying it's an additional financing in the lease. Mwalimu will pay more because you gave Mwalimu more money. Mwalimu will do what? Will pay more because he received more money. That's why we are saying any above market terms. Above market terms means you paid more. You received more as a seller. You received more money. Therefore, there is what we call an additional financing. Thank you very much. You say well understood. Thank you very much. That is my joy. Okay, let's move on to another thing. Let's move on to another thing. And another thing is we look at a question. We look at one question. Quickly, we look at one question before we conclude this concept. Now, the question we are going to look at is December 2021. We are going straight to December 2021. Let's go straight to December 2021. December 2021. December 2021. Quickly, question number 3. 3A. December 2021. Question number 3A. December, quickly. Quickly. December 2021. Question number 3A. Yes, Lenene, what you are saying is correct. You are selling the asset, and again, you lease the asset for your use. Therefore, that is what we are saying here. The asset is originally yours. You sell it, but still you need to use this asset. Therefore, you again lease the asset. That is what we are discussing, sell and lease back. I believe you have gotten December 2021, question number 3C. December. December. Anyone who is there, you just say yes, or you put thumbs up. If you are there, you put thumbs up, or you say yes. Thank you very much. Sherry, you are already there. Maggie, you are already there. Thank you very much. Everybody is there. Therefore, let's look at this question of December 2021. In December, the question papers, they were pilot and the sitting paper. Therefore, we are not looking at pilot, the sitting paper. Question number 3. The sitting paper says, Harry Limited sold a building at its fair value of 112 million to a finance company on that 1st October 2020, when its carrying amount was 78.4 million. The building was leased back from the finance company for a 5-year period. The remaining economic useful life of the building was deemed to be 25 years, so it could be concluded that the control of the building had transferred to the finance company. Lease rentals are $998,56,000 payable annually in arrears. Remember, we said something yesterday. You pay in the other day, you pay either in arrears or in advance. Here, we are going to pay in arrears. The interest rate implicit in the lease is 7%. The interest rate implicit in the lease is 7%. The present value of annual lease payment was $43,200,000. Harry Limited recorded the cash proceeds, they recognized the building and recorded the profit on disposal of $33.6 million in the statement of profit or loss. No other accounting entries had been posted. Required, with reference to International Financial Reporting Standard IFRS 16, leases, and with suitable calculation, explain the accounting treatment of the above transaction in the financial statement of Harry Limited for the year ended at 1st October 2021. Therefore, we are going to see how you account for the sale and lease back. Let's read the question because it's better we understand the question than just doing it. Make sure question number 3A, December, that is December 20. There are those who are asking December 26, 2021. Question number 3A, Harry Limited. Now let's read the question quickly. Harry Limited sold a building. Therefore, Harry Limited is the owner of the building and it sold the building at a fair value. Therefore, the fair value of the building, fair value equals to 112 million. 112 million is the fair value of the building on that 1st October 2020, when its carrying amount was 78. The carrying amount of the building, was 78.4. 78.4. The carrying amount was 78.4. Let's go quickly. And the building was then leased back from the finance company for 5 years. Lease period is 5 years there. This period is 5 years. The remaining economic useful life of the building was deemed to be 25 years, so it could be concluded that control of the building had transferred to the finance company. Lease rentals are 9. Therefore, lease payment, minimum lease payment is 98, lease payment is 98,56,000. Those are the lease payment. Minimum lease rentals is those amount. Minimum lease payment payable annually in arrears. Payment is in arrears. Payment is arrears. Therefore, this will determine our amortization schedule and how we recognize the liability, because we are paying in arrears. Interest rate implicit is 7%. Interest rate is 7%. The interest rate implicit in the lease is 7%. The present value of annual lease payment was 20 million. Therefore, the lease liability, examiner was wishing us success. He has given us the lease liability already. The lease liability is 4320,000. 4320 as the lease liability. Therefore, the examiner is doing what? Wishing us success, because he has given us the lease liability. The lease liability. Harry Limited recorded the cash proceeds and recognized the building and recorded the profit on disposal of 33.6 million in the statement of financial position. Therefore, out of this sale, this person, Harry Limited, recorded a profit. How did Harry Limited get the profit? When you take 112, the cash proceeds, minus, that is the fair value, minus carrying amount, you get the profit already, the profit. Therefore, Harry Limited took 112 minus 78.4. Then he got 33 point what? 33.4. 33.4 or 6. 33.6. He reported this profit, which is a big no. That is not the profit you are going to do what? To report. According to IFRS 16, if you report this profit, then you are very wrong, because under IFRS 16, we are going to compute the profit, the gain or loss, as the rights transferred to the buyer only. Therefore, this was a very big X there this person did. Therefore, here, we are going to recognize this list. But before we start recognizing this list, let's have a break of 5 minutes. A break of 5 minutes to allow our brothers to pray for us. 5 minutes for our brothers to pray for us. Then we come and continue. Just 5 minutes, kindly. Don't go far. To allow our brothers to pray for us. Then we continue again. 5 minutes break. Stay with us still. I hope you are back. I can see Ido Zundwa, you say iko sawa, tuko sawa. I hope everyone is there. Can we proceed? Thank you very much. Thank you very much. After prayers, now we are fresh. Thank you very much. Okay, let's now see how to recognize and de-recognize this lease. Remember, first we are required to get what we call the right of use. How do you get the right of, because already we have the lease liability. But if the lease liability was not there, how do you get the lease liability? Lease liability equals to a present value interest factor where you take 1 minus 320. Now we want to get the right of use. Right of use, right of use, right of use, right of use equals to, we said, we are going to take the lease liability divided by fair value times the carrying amount. When you check in our notes, we say that the lease